So many people with traditional IRAs and 401ks have Roth envy. They want to be over at the Roth party where your money grows free and comes out totally tax-free at retirement. But I want to go over 5 mistakes people make when they convert to Roth. We love Roth IRAs. We're converting clients' accounts every day here to Roth at Directed IRA. In fact, Roth IRAs are the #1 most popular account type we have. And the reason for that is the tax-free growth and tax-free distributions when you reach retirement. Remember, those of you with a traditional account, you are going to pay taxes on the way out as you're pulling the money out. So you can convert that. You can get over to the Roth party and do a Roth conversion. All right, let's hit the 5 mistakes that people are making. The first mistake is not being strategic to minimize your tax burden. When you convert from traditional to Roth, remember the dollar amount of the conversion goes into your taxable income. If you convert 100 grand, you're going to get a 1099-R for $100,000 that's going to go on your 1040 tax return in the year you convert. Now, what does that mean? If you made $150,000 that year and you got a 1099-R for $100,000, you've made $250,000. You have $250,000 of taxable income. That's going to bump you up into higher tax brackets. So we want to be strategic about when you convert in your specific situation. Now let's look at the 2024 tax brackets to see how this works. As a general rule of thumb, when you're down here in the lower tax brackets, let's say you're in below 22% or less in the tax brackets, converting to Roth is a no-brainer. In my mind, 22% federal tax rate, it's a no-brainer to convert. We're obviously thinking about what's the tax rate when I hit retirement. Tax rates are probably going to go up over time. By the way, I'm going to come back. They go up in 2026. We're going to come back to that here in a moment. We're generally expecting rates to go up over time. That's what they've done traditionally. This is just government policy. Love it or hate it. That's just what's happened over time. Now, some people do think, yeah, but Matt, I'll be in a lower tax bracket in retirement. I won't have my high-paying job, or I won't have my income from my business. The reality of that for most of our clients, I'll be honest, that have built up assets, that have businesses, that have rental income, that have investments that they're living off in retirement, is they actually aren't in a lower tax bracket. Some of you might be, and this is situation specific. Maybe you're a high-wage W-2 earner, and you're going to drastically reduce your living expenses and your lifestyle when you hit retirement, so you will have lower income. That's possible, and that can happen for some people. But from my perspective, if you're in these lower tax brackets, 10 to 22%, just convert the whole damn thing. All right, but I want to look at one specific area of the bracket where we see a lot of clients and they think there's some good tax planning opportunities. Right here, as you see, from 24 to 32% is an 8% jump. It's one of the highest jumps in any of the individual brackets, and it's happening in a very common area for single and married filers. The high 100s for those single and the high 200s for married. Remember, this includes the amount you're converting as well. So in that big of an area where you have a tax bracket, and frankly, all the way up here in the 35 and 37% brackets, you may want to try to chunk this over time to reduce the tax burden. So when you're bumping up to this 32% tax bracket, this is a higher tax rate. There's more pain here to convert. You may want to chunk it. This is a strategy we use with many of our clients where we say, if you're in higher brackets in particular, and you got that 100K to convert, you might want to do 50K of it now in 2024, and then January 1st, 2025, convert the other 50K. That way we're breaking up the tax liability between 2 years, spreading it out. Sometimes it helps us from hitting the next tax bracket. Like I said, this 24 to 32, that's an 8% jump, and that can be beneficial to help us save taxes on the amount we're converting. Now, you can chunk over 3 years, 5 years, doesn't matter. I'm just giving you an example here to think of how do I create a pathway to get all my dollars in Roth, and just realizing you don't have to all convert in 1 year. Now, if you have a low income year or you have losses in a business or other situations like that, convert in that year. Take advantage of that, particularly if you're in the 22% or lower brackets. Just get the whole damn thing done. But if you're in a higher bracket, think of chunking over time to reduce that tax burden and spread it out over multiple years. All right, now another big consideration right now of why you should be thinking to just get it over with now, maybe chunk it over 2024, 2025, or just get it all done in one of those years, is higher tax brackets are on the horizon. In 2026, federal income tax rates are going up. The highest bracket is going from 37% to 39.6%. And if we look at the chart here, every bracket, once you get to 15% or higher, is higher. higher. There is more taxes on the horizon from us from the federal government. This is a result of the Tax Cuts and Jobs Act, which was created back in 2017. However, it's set to expire in 2025. So we're going to go back to higher tax rates. So a great time to convert would be now in 2024, 2025, whether you're doing an all-in-one year or chunking. Take advantage of the lower rates that are on the table. Now, who knows what's going to happen with elections? Who knows if legislation is going to pass to extend these lower tax brackets that we have? I don't know. I'm just saying if you want to be certain and lock into the lower rates, look to converting now or in 2025. All right, the second mistake people are doing when they convert to Roth is they are taking a distribution from the traditional account to pay the taxes. Guys, this is a dumb idea. If you're under 59 and a half, not only does that come into your taxable income because it's traditional dollars, but you're also paying a 10% early withdrawal penalty because you're personally taking the money and giving it to the IRS. Now, a lot of people think, well, Matt, isn't there an exception for the penalty to take a distribution to pay taxes on a Roth conversion? No, there is not. All right, when you're converting from traditional to Roth, we want to satisfy and pay that tax with money outside the retirement account. So if you have a $100,000 traditional IRA that you want to convert to a $100,000 Roth IRA, you're going to convert the whole thing, and that whole $100,000 is going to go over to Roth. Do not withhold money. This is a big mistake people make because a lot of times it's the option at the form from the custodian to withhold money to pay the taxes. Guys, this is causing a distribution for those of you that elect this option, which is causing taxable income plus a 10% early withdrawal penalty for those of you who are 59 and a half or below. Now, some people are like, but Matt, I still want to convert, but I don't have money to pay the taxes. Well, maybe you need to get ready and get some money set aside to cover the taxes, or even worst case scenario, get into a payment plan with the IRS to pay the taxes over time. That's going to be cheaper than taking that money into taxable income and paying a 10% early withdrawal penalty. All right, mistake number 3, assuming you're going to make less money next year, and so you never end up converting. A lot of people think, well, I'll be in a lower tax bracket next year because I've just had a really good year this year, so I don't want to convert this year, but next year I probably won't, so I'll convert. Really? Some people tell themselves that to talk themselves out of converting to Roth, even though they know they want to convert to Roth, but then they never make less money, so they never have a Roth conversion. So you gotta stop thinking that you're gonna make less money next year. Most of us are planning to make more money next year in our business or in our job where we may be employed. We're hoping to get a raise or to have more income. So be careful falling into that trap of thinking, I'll convert next year when I have lower income. All right, mistake number 4 people make, they don't convert by the right deadline. A lot of people understand April 15th is the contribution deadline. So even by April 15th, 2025, I can make a 2024 Roth IRA contribution. But the conversion deadline is not up to April 15th. It is December 31st. So if I want to convert for 2024 taxes, I need to convert by December 31st, 2024. You do not get up until April 15th. So make sure you get the deadlines and timing right when you're converting. All right, mistake number 5. The final one here is people thinking there's just an easy button and I'm just going to convert. Guys, you need to understand when you're converting from traditional to Roth and you're chunking, let's say I got that $100,000 traditional account that I want to convert to Roth. I'm going to do $50,000 this year and $50,000 next year. Well, when you convert in any instance, you need a Roth IRA. So you need to set up a Roth IRA. You already have a traditional IRA. You're going to need to do a Roth conversion form and elect and agree to convert to Roth. But if I'm chunking and doing this over 2 years, you're going to still have a traditional IRA and you're going to have a Roth IRA. You're going to have 2 accounts and 2 account fees. Now, if you're wanting to convert the whole thing all at once and just bite the bullet for whatever reason, maybe it's strategically beneficial in your tax situation. If you want to bite the bullet and do the whole thing at once, what you can do is you will convert the traditional to Roth, but you still need a Roth account. But then you can close out the traditional so you just have one Roth account moving forward. Roth IRAs are super powerful and you can get to them by converting. Now, there's a little bit of pain because of the taxes due to convert. There's federal and state tax depending on the state you're in, but the benefit of it is huge. Just think at the end of the day, when you're in your 60s, would you rather have $1 million traditional IRA or an $800,000 Roth IRA? For me, I'll take the $800,000 Roth IRA any freaking day because that traditional IRA, as I'm pulling money out, it's really not $1 million. If I'm in a 25% federal and a 5% state income tax bracket, that $1 million traditional IRA is really a $700,000 traditional IRA. All right. The Roth IRA, on the other hand, it's really worth $800,000 because it's coming out tax freedom, no federal, no state income tax. Thanks for watching. I hope this gives you perspective on converting to Roth. Now, please subscribe to my channel. I've got a lot of videos and content on how to use Roth accounts, how to take control of your retirement, how to protect your assets, save taxes, build the American dream. We'll see you next time.